One.
Hello, everyone. Welcome to another episode of PB&J podcast. Today's episode is sponsored by Neodocs, which brings diagnostic tests to your smartphone and enables you to do instant tests at the convenience of your home. In today's podcast, we'll be talking about startups and journey of a startup. Like startups have can be traced as long as 1800s. A startup is, for all practical purposes, a company which builds a unique product or a service, and it starts off with targeting a niche and then slowly expanding to become going outside that niche, serving problems for more and more people, adding products, and turning into a profitable corporate. Examples of certain such startups can be like Microsoft, Apple, Netflix, Google, are all started off as startups and now have become multinational conglomerates. A startup specifically looks for a gap in the society or a problem to solve. The founders start off either they have observed the problem or have faced the problem themselves, or know someone close who has faced the problem, are moved by thought of solving that problem, start off with that niche and slowly build along that, keep adding keep adding consumers, gathering feedback, finding a product market fit, and then scaling up that product to uh, potentially hundreds of thousands or millions or billions of users, depending on the sector or the domain that they are in. So we'll be talking about the different sectors. For example, in a startup, are like healthcare, hardware, e-commerce, fintech, cybersecurity, electronic vehicles, and startups when they exceed a valuation of $1 billion, it is termed a unicorn. So it is similar to a magical mythic figure, where like the value is immense, and this is the term that is used for $1 billion plus startup. There are multiple $1 billion plus companies that have come across, especially from in a high number in developed economies like US, and even in like countries like India are churning out a lot of unicorns in the past 5 to 10 years. So here's the like how the landscape looks of different $1 billion plus companies and their breakup based on the countries, some notable companies, and when did this start off. So talking about startups from a perspective of Indian perspective and comparing it with the number one startup factory in the world, that is US. This is how it looks like. So for example, in terms of population, US is 328 million people, India is 1.36 billion people. But if you see in terms of a number of startups, US produces 65,703 produced 65,703 startups, and a stark contrast, like almost 1/8 of what US produced is what is produced by that immense population in India. In terms of like the funding, if we see in US, there was approximately $75 billion that were invested in startups, and comparing it with India, around $10 billion uh, were invested in startups. And like if we see like what might be the reasons for these, so then the next number, that is the number of incubators or accelerators that are present in both of these economies. So these accelerators or incubators, in essence, what they do is they create an ecosystem for startups to thrive, de-risk the co-founders, help them grow, help them connect and network. So if you see, there are around 1,500 plus such entities in US, whereas there are only around 250 odd entities in India, which are providing training, mentorship, capital, and networks to grow. And if we like look at in terms of ease of doing business, so US ranks number 6, India ranks number 63rd in the world in terms of ease of doing business. And again, coming to unicorn, so if we see all these figures and then have a look at the number of unicorns, so US has produced 369 unicorns till now, and India has produced just 53 unicorns. And the scenarios though are changing very fast, where India is producing more than, like in this year itself, it has produced more than 10-12 unicorns till now, and it is just, the year is yet to complete. So in India, for example, India is gaining fast traction. People willing to look at entrepreneurship as a viable alternative post graduation or post their college education. And cities like Bangalore, Delhi, Mumbai have turned up as hubs of startups, where the ecosystem is getting developed and is well connected. COVID, in fact, has like pushed a lot of things to their edges, and it has made some of these things more conducive, where one can operate from remote locations, no matter where they are located, manage teams remotely, do the work, launch product, make the sales, bring business, and like earn revenues irrespective of the location. So those things are also, the barriers are getting reduced to start a startup, both in terms of uh, like physical bandwidth limitations, as well as financial or capital bandwidth limitations have gone down by a lot, where you can now start a startup from just a few thousands of rupees, and that is what it takes to bring in traction, show certain product market fit to an investor, and raise go on to raise investment as you proceed in the journey of a startup. And we'll talk about different phases in a startup's life and the financing stages as well in a while. So let's look at the unicorns that India has produced till now. So if you like, some of these names are very familiar to everyone, like Zomato, Nykaa, Big Basket, Swiggy, Lenskart, Quicker, Paytm. So these are some of the most common. Ola, for example, these are some of the most common day-to-day use cases, where the startups have built so much of value that investors want to invest in these companies, not just from India, but from entire world. Investor want to invest in these companies and are willing to give them a valuation of more than $1 billion. So the valuation is generally like what an investor is willing to pay for getting a stake in the company, and that in turn reflects the confidence of these investors who are vetted people, who have vetted these startups, are experienced people from the domain, and they understand the uh, like width and depth of this ecosystem, how far these companies can grow. So for example, there have been very successful exits as well in this space, where for example, Flipkart sold to Walmart for in a billions of dollars of deal, and the founders in fact made became billionaires, and this money then came into as liquidity in the market again, where the founders are now giving back to the community of startups, investing in new companies, and providing them with support, their learnings, and like encouraging the next generation of people to start up such companies. And these successes have also like incited confidence in the youth in India, that there is a scope in terms of like, it is a high risk high reward thing, and there are a lot of n number of problems that can be solved, and one just needs to pick a problem, just solve the problem, find a product market fit, and like just then once that is there, just scale it up to a bigger market. And a lot of these startups have even expanded outside beyond India and have grown into multinational companies. So as I told that this year itself, we have produced as a country more than 12, 13 unicorns. So on the right, you can see like some of the unicorns that came up this year in India, like Meesho, Farm Easy, Digit Insurance, Innovaxer, ShareChat, Gupshup, Grow. So some of these have also become common household names. For example, companies like Urban Company. So let's look at like what it is that it takes to build a startup. So phases in a life of a startup. Initially, how it starts and snowballs into what we call a unicorn, or these days a lot of companies are slowly moving away from being a unicorn and moving towards being a decacorn. So So the stages are that people who are actually moved by a problem statement or want to solve an issue, they come up together, form a team, or start off a small venture. It may or may not be a formal company. uh, they find out a problem, they develop a solution. It may not be the most finished product that you might see, and just test it out with the initial set of users. So these people are generally called early adopters, and this is where your problem solution fit is what you are exploring. Like in the timeline, if you see, the MVP is a minimum viable product. So you do not want to add each and everything, because startups are a very fragile creature. So like you have to be frugal in both in terms of time and capital. So to develop an MVP, which is the core of your product, reach out to people for whom it solves something or adds value to, and start looking for a product market fit. So what all these things entail are like finding people and a repeatable way who have this problem, finding out whether this market can like more people have such a problem. It is not just the founders or one in a million or billion people having those problems. Then searching for channels, how to like in essence understanding these people, how they behave in like their day-to-day life, how they select products, or how do they currently solve that problem. Then like reaching out to them through different channels, finding the product market fit to post MVP, then finding the channel market fit. So the channel with which you want to reach them, like for example, examples of channel are a mall, a shop in a mall, a distribution network, like brick and mortar network, or a e-commerce, which is very famous. And in fact, the pandemic has given it much of a tailwind, where a lot of people have necessarily shifted to online purchases. And once you have got the product market fit and the channel product fit, it is all about scaling. So by now have developed a playbook where you know what it takes to set up. Say for example, setting up a you have found a product market fit and have established the channel market fit in say a constrained geography of say Mumbai, or a particular locality in Mumbai. Now you just want to make a playbook out of it. The playbook is a set of like repeatable steps that you just need to now reproduce in say Bangalore, in US, in Japan, in Singapore, to achieve that same results. And then just yes, pour in a lot of resources for that growth and achieve like maturity. And that is when you either are moving towards becoming a unicorn or becoming a bigger corporate. So what advantages that being a startup offers is that you have a very lean structure. You can do things which corporate is afraid of doing. For example, Virgin Airlines, when they started off, they were offering limousines rides to people who were traveling in the first class, and a lot of big airline companies were not able to achieve that or match that experience. The sheer reason was that like only a handful of people were traveling in the first class in Virgin Airlines, whereas the other big companies had hundreds or thousands of people traveling daily in the first class. For them, achieving this was would have required a lot of capital, whereas Virgin Airlines was able to do achieve this in a low amount of capital. So the leanness is one of the edge, that agility, leanness, being agile, being fast in adopting changes is what makes startups different. But there are a lot of as I told, that it is a high risk effort as well. So for example, some of the metrics on the right, that 9 out of 10 startups don't make it. A lot of people are able to make the MVP but not find a product market fit, or even if there's a product market fit, they do not achieve a channel market fit or a distribution. A lot of people develop solutions looking for a problem to be solved. So that is another contradictory way of finding and building a product that people want. And like depending on like the conviction and all, people sometimes pivot their ideas, pivot their business models, pivot their products, or sometimes unfortunately a lot of startups shut shops, and either due to lack of a product market fit, or the capital going away, or the team disbanding. So some interesting statistics are shown on the right of this slide. So different stages of financing, if I have to quickly take you through. So initially, when you are developing an MVP, you're looking for a or looking at a problem statement and have an idea to solve it, have starting to work on it. That is where the seed capital, the angels, what it is termed, that literally these are people who have uh, worked in that sector or understand the problems that a startup faces, or have certain insights for the people and become angels for them, giving them the seed capital to as it and like entails the meaning of seed itself, that you are sowing a seed to start a like you're sowing a seed so that it builds up into a tree, which is a IPO or a public market company, grows up till that stage. So that is where the seed capital or the angel investment comes in. Then like a lot of startups, why it is called the valley of death is that a lot of startups die during that phase, where they are either out of capital. If they would have had a slightly more capital, they would have had a more runway, would have raised secondary rounds, or would have achieved the product market fit. Certain startups like die out because there was no product market fit and the capital as well ran out, or the team certain times there are founder conflicts and the team disbands, and which was crucial for building the startup forward, and people are not able to find relevant people with the talent that is needed for continuing that startup. Then once if you are out of the valley of death, then the real journey, where what starts is now you have probably achieved a product market fit and are moving towards expanding or growing or adding more products to the kitty, and that is where you start off with post seed rounds, like series A, series B, series C. So first, second, third, the steps that are given are the early stage steps, where typically institutional investors, not individuals, but people whose business is investing in startups and making financial returns, they come in with a bigger check size, with bigger networks, and they help you achieve growth and infuse capital. And so a lot of times they are helpful in building networks and channels, because of their like being in the business of investing, they have a lot of connects with other startups or distribution networks and all. So these series A, B, C, once you traverse them, and if you are lucky enough to survive till then or achieve revenues or growth, you move towards these mezzanine rounds, which are like makeshift rounds before you are opening up to a IPO or a public market. So this is how the typical cycle looks. A lot of startups, like if they are adding immense value and other companies or other startups look at them as being a complementary or a good acquisition, a lot of startups also even get acquired at different stages, where either the companies who are acquiring are acquiring them for their customer base or their product or their team, which could add value to these companies. So that is another. So these are called exit opportunities. So IPO is, for example, is an exit opportunity for investors or for founders to make money. Acquisition and mergers are potential opportunities that where the founders or the investors make money. And this is how the entire round or the financing of a startup looks like. These are the different phases in the life of a startup and the different financing stages. This is we also went through the current scenario of startups in India, and we'll be back with more insights into how these things work, how to achieve a product market fit, or how to start off in your journey to achieve a product market fit, or traversing these various rounds of financing in future podcasts. Till then, have a great weekend, and we'll connect soon. Thank you, everyone.